In 2022, the world watched the invasion of Ukraine in horror. As oil prices spiked, gas stations raised their prices overnight. Families across the globe began cutting back on basic groceries just to cover their fuel bills, while economists warned of a looming global recession. But inside the energy sector, the numbers told a different story. ExxonMobil made $56 billion in profit, the most in its 152-year history. Shell took $40 billion, BP $28 billion. $124 billion extracted legally from the same crisis that was draining your bank account. Despite 6 months of debate, not one emergency windfall profit tax passed in the United States. Congress discussed the proposal, then buried it. Now, the Strait of Hormuz is closed. 1 in every 5 barrels of oil consumed on Earth is caught behind this single choke point. Brent crude has climbed to $107 a barrel, and it is still rising. Personal finance channels are advising you to build a 24-month cash buffer. But while you prepare for the hit, you should be asking, who built the system that made that buffer a necessity in the first place? This pattern repeats with mechanical precision. In 1973, an oil embargo quadrupled prices and triggered stagflation, while corporate profits surged. In 1979, the Iranian Revolution doubled prices and a global recession followed. In both percent in 4 months. In each of these historical instances, the timeline of severe consumer burden at the pump aligns with the peak of oil company revenue reporting. We saw the same mathematics apply during the 2022 Ukraine crisis, and we are seeing them again today in the Strait of Hormuz. Financial markets drive this through the geopolitical risk premium. Traders don't wait for a supply disruption to actually happen. They buy oil futures ahead of the crisis, driving prices up through anticipated scarcity. By the time you reach the gas pump, the profit has already been secured by the financial markets. The panic itself is the market signal. If you want to understand how the global economy actually works behind closed doors, hit the like button and subscribe. Let's look at what they do while you panic. When a supply shock hits, oil executives publicly express concern about supply chain stability. They appear on financial news to discuss the uncertainty. Privately, the operational reality is different. While companies can accelerate drilling or release reserves to ease a supply crunch, they routinely delay these actions. Every week of elevated prices represents a specific financial gain. This chart shows the daily impact of that delay. Moving the price from a $75 baseline to a $107 crisis premium generates $640 million daily. Stalling a production increase for 6 weeks stacks those premiums into billions in pure profit. This creates a contradiction. While the Public Relations Department speaks about price stabilization, the commodity trading desks are positioned to profit from continued volatility. In 2022, the oil and gas industry spent $124 million on federal lobbying. This wasn't for innovation. It was to ensure that windfall profit taxes never made it to a floor vote. The return on that spending was historic. For every dollar the industry spent on lobbying, it recovered $1,000 in untaxed windfall profit. This protection is maintained by a revolving door, with federal energy regulators exiting to take seats on corporate boards. The architecture of oversight is managed by the very industry it is meant to regulate. This system is designed to be self-replicating. Staying ahead of these dynamics requires understanding exactly where that extracted capital is flowing. Subscribe to the channel to track the movement of wealth. Let's look at the micro-reality. The Strait of Hormuz crisis will cost the average household an additional $2,000 to $3,000 this year in energy and fuel costs. Multiplied across 130 million American households, that is a wealth transfer of up to $390 billion, pulled directly from consumer budgets. The production cost for a barrel of oil hasn't changed. Consumer demand hasn't changed. Only the market price has moved, driven by the interests of those who profit from the spike. For an ordinary person, a sudden 20% decline in their portfolio can permanently impair their ability to retire. They are forced to sell assets at a loss just to cover basic living expenses. On the opposite end of the transaction, market architects operate in a reality where geopolitical disruption functions as a primary harvest cycle, with profits that scale alongside the level of global volatility. Mainstream personal finance advice tells you to build a cash buffer and delay spending. That is genuinely useful damage control, but it is teaching you to survive a system that was built to empty that buffer on cue. The extraction runs on a schedule. The lobbying protects the windfall. Trading desks profit from your panic. Subscribe to the Prometheus Playbook to learn the secrets of the global elite.